Welcome to another edition of Brooks Macdonald podcast. This week I am delighted to be joined by Priscilla Cheung, a senior investor with Brooks Macdonald. Now, before I go any further and bring Priscilla into the conversation, I would just like to reiterate what we usually do at this time of the call, which is the podcast, which is to remind you that nothing we talk about in this conversation should be construed as a recommendation. We are talking about illustrative stories and really trying to illustrate how we at Brooks Macdonald invest in multi-asset class funds and portfolios in diversified fashion. In terms of what we're going to cover this week, there's an awful lot going on in markets and the world economy as usual. That's why it's good to be joined by Priscilla to help sort of get through it all. Obviously, a lot of it is to do with corporate earnings. Some of the biggest companies in the world have been updating us on their latest earnings, their plans, and all of those kind of things. And there's some big thrills and spills in there. Also, obviously, we're hearing a lot about the new UK administration, and I hear the journalists are calling Number 10 North as Mank-a-Lago, which I quite like. And in the context, the wider context for this is that the macro economy, the global economy on which, the outlook for all investments is based, is still doing very well. Europe seems to be accelerating. Even the UK data seems to be bending upwards a little bit. So yes, it must be summer. Priscilla, with that, help us navigate, help us find a little signal in amongst all of that noise. Let's start with some thoughts from corporate earnings season, I guess particularly in the US. Like I said, I know we've had some of the Titans report earnings. What's your overall sense?
So I think overall the earnings season is going really well. I think roughly over 80% of companies, they're beating their expectations. They're beating their profits expectations. And I think even in terms of the commentaries from the senior management from these companies who have reported, they have highlighted resilient demand. They have highlighted, resilient industrial activities as well. And at the same time, they're seeing productivity gains coming through from AIs. So it's all good news, I think.
No bad news whatsoever. Well, it's interesting because that's consistent with what we talked about a couple of weeks ago with regards to the major banks in the US who reported. And obviously that gives quite an interesting read on the underlying macro economy. And you were seeing very strong loan growth from not just for hyperscaler CapEx, but more broadly consumers as well. But what about some of the sort of big names in the last week? And I know this has been very focused on the sort of technology side. What are your thoughts there?
Yes, and I think this is really the most interesting part of the market. We now have 4 out of the 7, Magnificent 7, reported their earnings. And it has been so interesting. I think the biggest takeaway is that investors are becoming a lot more discerning, especially when it comes to CapEx expectations as well. So say, for example, Microsoft is really the standout here, right? They have reported very healthy cloud revenue growth. And at the same time, they were rewarded. Their shares were up, close to 9-10% in after hours.
Yeah, that's amazing.
But at the same time, right, Alphabet, they have reported last week. Similar sort of story. They have also generated relatively healthy cloud computing growth and things like that. But at the same time, they have reported that they are increasing CapEx, right? And as a result of that, their shares were actually down around 7-8% in after hours. So drastically different reactions from investors. And I think it's fair to say that AI demand remains really strong. But at the same time, market is no longer just rewarding spending for spending's sake. And investors are becoming, they increasingly want proof that, spending CapEx is really translating into profits and growth numbers.
How interesting. So a sort of show me type vibe, I think they call it. And it's interesting, your point there that you're emphasizing about how the CapEx, capital expenditure being pared back a little bit is being rewarded. And I guess that also kind of helps explain a little bit what's been going on in some of the sort of supply chain stories this month, because obviously we've seen a complete total wipeout in memory stocks and some parts of the supply chain. So a lot of the chip and other supply chain, which is benefiting from all of that that capital expenditure. Clearly, investors were anticipating some of this pullback in capital expenditure and actually had been punishing the memory stocks in advance. Does that chime with what you're seeing?
Yes, exactly. I think chip stocks, especially, they have come under immense pressure. And I think Korea is a really good example because it's a very concentrated market in terms of memory stocks. So in the past, I think 5 to 6 weeks, Korean markets, they're down almost 50%. Right. So the drawdown is definitely very hefty. I think it's a very useful reminder for us of diversification, right? We don't want to put all our eggs in the same basket. And I think it's fair to say that AI will be a long-term powerful theme, but at the same time, even amongst the biggest companies, there will be differentiations, there will be winners and losers. So we do have to be a lot more careful in terms of where we put our money. I think regional diversification and also sectoral diversification, these are all very, very important now.
And they're what our colleagues at Brooks have happily been doing for several years now. So, yeah, it's interesting you say that about the career side, because I remember when you last came on, you were talking about how there was a levered ETF exposed to these memory stocks. I mean, some investors must be sitting on nursing some fairly horrible results. Leverage is fine on the way up, but obviously on the way down, it hurts a great deal. And just what you say there really chimes with, I guess, some of the lessons from past historical change when, and we've been making this point quite a lot on this podcast, which is historically investors seem to over-fixate on the originators of a technology, and they underestimate the impact of technology, and they overstate the returns to the early innovators. And to a certain extent, we're kind of waiting now for, the next stage. And if you look back at the last the tech bust that everyone's thinking about now, the 2000 bubble, I don't think it was that investors miscalculated the growth potential of the technology, the internet, the technology, sort of the TMT revolution, but they just attributed too much value to the companies that build technology and infrastructure to provide it. And the ultimate winners, if we think about it and go back to that time, they were companies that were able to free ride off the spending that the 90s equivalent of today's hyperscalers were doing, and use that capacity to build business models that could leverage the technology. And stuff like ride shares. I mean, actually, many of the winners didn't emerge really until smartphones came along in 2005, 2006. And the proliferation of apps that then spawned technology, a growing industry of platforms, ride sharing, all the food delivery apps that we now rely on. So in a way, I guess the message from history is, diversify beyond the original winners and do what the guys are doing, which is really try and look for value in the adopters and some of those. And we may have to be a bit patient.
Yeah, I think that is exactly right. It's about the second order and the third order effect. But I think in your example of the 2000s, rising interest rates has had probably a role to play there. Nowadays, we've got a lot of changes in central banks. They're changing the narrative as well. We've got a new chair at the Federal Reserve, Kevin Walsh. I think the biggest change is that he is refraining from giving too much of a forward guidance. So every meeting could be a surprise. Is it fair to say that? And at the same time, I think in terms of the narrative around inflation, there has been a lot of, divides just within central bankers, just amongst the central bankers themselves as well.
Yeah, no, it's interesting. I mean, I personally, I welcome the idea that central bankers would be doing less forward guidance. I always felt there was a kind of hall and mirrors effect where immediately, because investors knew that they were being guided by central bankers, they responded to the guidance as such. So it just became ridiculous and a lot of time wasted as a result. More broadly, though, you mentioned at the start of your comment a little bit about how interest rates had a role in popping the previous bubble. The one thing I would like to point out, just because there's a lot of clients also, to your point, worrying about the role of interest rates at the moment. Are they getting too high? Are we at choke points? And what happens next, kind of thing. And just remember that with 2000 and 2001, the recession, the UK didn't even have a recession after that tech bubble bust, for what it goes. The US recession that came about in, I think it was late 2001, actually, in a way, it was almost revised away. It's only 2 quarters, and it coincides with a huge amount of other stuff. And this is consistent with the lessons from history in many ways. We often want to teach these things as a kind of parable of excess and then, the fast, the diet that gets you back into shape, but, morally or otherwise. But the reality then, if you think about it, a lot had to go wrong in the US. So you had, the 2-quarter recession was during a period that contained 9/11. So the complete closure of American airspace, physical damage, fear and uncertainty, and all the horror that came with it. You also had a massive stock market sell-off. And through 2000, you had energy inflation running in double digits in terms of percentage terms. And you had the China shock. And that's, a pretty sudden loss of about 3 to 4 million manufacturing jobs, really starting in 2000 and sort of going up to 2007. So in a way, I sometimes think like the desire for moral clarity, we always sort of say, well, it was, the excess and the exuberance of the tech bubble, and then we had to pay the price afterwards, and that's how it goes. But it was so much more complicated than that. And I think we can take that lesson onto today in many ways, which is that, there's stuff going on in the stock market, and you alluded to the memory stocks and some of the other kind of leverage plays and some of the other worries you've got. But remember, generally, the underlying health of the US economy, it'll take quite a lot to upset that apple cart. And that's been one of the lessons, I think, from, President Trump and sort of some of the battery of quite strange policy measures we've seen during this second term. I don't think I answered your question, but I went on my own little rant as usual, but yes.
But I fully agree, because we do have a tendency to look for a culprit.
Yes.
But at the same time, there are just so many different factors in play. But I do know that, in terms of bubbles, you do feel that, a bubble could be part of a major technological change for the future.
I think they're important. It's a weird thing to say, but in a way, like you need, and we've made this point again, that bubbles and high valuations and high profits, they act as an incentive. If you think that sort of, the whole invention kind of piece is about attracting humans to solve problems. So you get the initial breakthrough, and then our wondrous fellow inhabitants of the planet, turn around and get to solving the various problems associated with that technology. And that's been the path of technological change in the past. And what you get is all those offshoot inventions, the changes to processes, how you organize companies, human capital, all those kind of things. And they happen down the line. But what you need is the incentive to do something about stuff. And I sometimes think bubbles do play an important role in that kind of thing, because you're sucking in capital, talent. And you think what's happening in Silicon Valley at the moment and elsewhere in the world with the sort of the hotspots of innovation, there's incredible breakthroughs happening, what seems daily, but on a regular basis. And, that is part of the story, that you've attracted the best and brightest to some of the sort of most important spots. So I do think, I'm not sure we're in a bubble just yet. I do think there's some sort of, there's some extreme parts, but that's kind of part of the process of future change.
And also, quite interestingly, this is also what's missing from the UK and Europe. As the IMF puts it, there is this sort of structural productivity problem in Europe. And this is how they phrase it. It's less likely in Europe that the right firm survives and thrive, and that the wrong firm exit. The weaker selection process results in the overabundance of small, mature, but low growth firms.
So yeah, it's really interesting, isn't it? Because I think that's something, if you look at the US, there, a lot of the decisions about what companies get it, what companies get funding are supercharged or de-emphasized is market-based. Banks play a much larger role in UK and Europe in that process. And so the sort of argument is, I guess, that markets need to be given more room to be able to, you need deep, big capital markets. And ultimately, there can be much more effective at weeding out winners and losers. I don't know, though. Sometimes I sort of think like we can be too down on ourselves. I was reading about something called the Pygmalion effect. I don't know if you've heard about this. This is a psychologist, Bob Rosenthal at Harvard. And basically they did an experiment and they put two cages of rats next door to each other. And one, they put signs by both cages. And by one, it said they were sort of specially trained, intelligent rats. And the other was sort of particularly dim-witted rats, or words to that effect on the signage. And ultimately, what you found was that it became self-fulfilling in tests because students handled them differently. And I sometimes think with the UK and Europe, we sort of need to remind ourselves of what the benefits of living in our systems are relative to the US. The US is incredibly dynamic, but ultimately there are sort of costs and benefits to both systems. And the other thing I think is that quite a lot of what we see in UK and Europe is semi-structural. You know, you can sort of think about everything from, I mean, there's one theory that sort of suggests that you can understand everything about Europe versus the US and some other sort of very different economies via a framework of how easy or hard it is to exit or enter into legal contracts. And so in the US, it's very easy. Ultimately, you know, you can sort of enter or exit very easily. And so what that means ultimately is the US can be very good at scaling up new products, and if they don't work, abandoning them altogether. Your whole education and political system is arranged around this thing. So you have a very high peak of the most educated, but then very sharp declines elsewhere. Whereas in somewhere like Germany, and I'm going away from the point again, but I think this is interesting. In somewhere like Germany, it's very hard to exit or enter into contracts. And so what you find is you need political systems, proportional representation, all these kind of things that are better at facilitating intergenerational bargains. Your educational system has a lower peak in terms of sort of excellence, but a much wider base of people who are up to a certain standard. And that means that those economies are much better at innovating iteratively about products that are already gone. So all of these economies have different strengths at different times of the invention and innovation process. So don't write off our model just yet, I don't think.
Right, that is also a very good point. But bringing everything back to the UK,
to something normal beyond rats and various, sorry.
So we do have yet again another new Prime Minister.
Yes.
So what's your read on this?
New Prime Ministers, not totally a new thing. I think over half of UK Prime Ministers since the war have come in between general elections. So it's not totally unusual. I mean, I do think in a way that some of the sort of things you can think about with the UK, you know, is the question you might have, and some people are sort of questioning about whether the UK is becoming incredibly difficult to manage in some ways. And what you could say is that large majorities are inherently unstable. That sounds weird, but because you've basically, in order to win a large majority, you know, from a fresh large majority, let's say, you're automatically winning in places you don't usually win. So your MPs are operating in places where they are possibly more sensitive to the underlying electorate, who aren't necessarily structurally sympathetic with your politics already. So you can get an inherent instability to it. The question, I guess, is really about what are they going to do? Are they going to change anything? You know, there's a new vibe, to use the modern word, to this government relative to the previous incarnation and all the sort of various inhabitants. But I don't know, there's probably not that much difference, just because the Starmer government had to make a sort of campaign trail blood sacrifice to get themselves into office, or at least they felt they did, which meant that there were red lines on taxes, on Europe, on all sorts of other things, very constraining. And, the new guys have sort of committed to keeping to that. So there are some little bits of wiggle room. You may find that they borrow a little bit more, that they change the sort of the nature of the tax take a little bit. I don't know how much room there is for that. And again, I would kind of say if the UK is starting to do a bit better, and I have felt like this for some time, and you are seeing it in the data, the sort of risk is that you sort of upset some little bits of momentum that you want to keep going. So I don't think there's necessarily some, it's not too negative to have someone who clearly is a bit more positive in communication terms, and sort of who will be a bit more of a booster about the economy than possibly his predecessor felt able to. But I'm not one who thinks that the UK needs profound changes. Some extra devolution would be useful, but policy stability, I think, is probably more important than most other things. We shall see.
So we don't really expect to see a major pivot in terms of policies, even though they're in terms of the cabinet composition.
Yeah, it's famous last
quite
words, isn't it?
different, right?
Yeah, it is. And there's lots of talk, isn't there, about sort of, you know, there's lots of talk about what they're going to do. And there's big talk about sort of reindustrialization, devolution, you know, and all sorts of sort of taxes and sort of a more confiscatory tax regime and some of the other things. But also, you know, you've also seen some rowing back already on some of the more extreme stuff. And the bond market, I think, will continue to act as a police person. And you pointed out earlier in the podcast that actually you've already got interest rates across the curve quite high, which reduces the operating space for, you know, new governments, all governments, to be honest. You know, you've got to try and sort of keep international and national lenders on side with all of your plans. They're who you're going to borrow from. So, yeah, I mean, I don't think also that many of the things that are talked about, I mean, there are some things that would increase the growth rate little bits over long periods of time if they persisted with it. I think, like, for instance, the regional transport infrastructure is something that did work well with Manchester and could work well around the rest of the country as well. I believe much more strongly in that than making it easier to commute to London from various other parts in the UK. That to me was always a little bit of a waste of time and money, that actually you know, create regional centres, and that's the way to sort of help with the levelling up story. But yes, I think it's going to be okay. Did you have any other further thoughts that you wanted to bring to the...
And I think, as usual, the biggest takeaway is that, you know, there are risks out there, especially from what we've seen with the earnings season, with what's happening with the mega cap tech names. I think it's fair to say that, you know, there will be more corrections along the way. But as you have rightly pointed out, I think a bubbly sort of nature is sort of, you know, it's an inevitable phase of a technological change.
Yes.
So for me, I'm feeling more hopeful than ever.
Oh, that's good to hear. Well done, Priscilla. Yes, no, that's good. And I think that's exactly the message that I think our clients and investors, you know, should really get across from this podcast, which is, you know, to a degree, close your eyes and stick with it, isn't it? I think, and you know, these times of technological change, they're enormously positive times to be invested over time, but you've got to try and find ways to stick with it. And I think a lot of that is to do with the valuation discipline that our colleagues, you know, are exemplary at, but also diversification across all asset classes and making sure that you're geographically, you know, diversified as well. I think we'll finish there. I've got loads more to say as usual, but I think I'll, you know, try and keep everyone on side by finishing up and just thanking you for joining us for this podcast. And please get in touch with any questions, abuse and disagreement as usual.